Hello, ladies and gentlemen, and welcome to the deck. In today's episode, I'm going to be reading to you a little bit, and it's about the current economic situation. And the main question I shall be addressing is the U.S. consumer back? Okay? Are you anxious? Let's dive right into it. Okay. Is the U.S. consumer back? The headlines told us that even as the economy fell an annualized 6% in the first quarter, consumer spending rose by 2%. Given that consumer savings climbed to 4.2%, unemployment rose, and income was down, how did consumer spending rise? To get the real picture, you have to dig into the numbers. First, the headline numbers are inflation adjusted. Consumer spending in actual dollars rose 28 billion. But since prices went down, meaning we had deflation, the real or after inflation / deflation number shows up in the headlines as 44 billion. But where prices went down makes the real difference. Gasoline and other energy costs were down 50 billion, allowing consumers to spend on other items. Over the last 2 quarters, energy costs are down almost 200 billion from the second and third quarters, making a huge difference. But now the tax cut from energy is largely gone, as prices have stabilized. See tax cut. Okay? But now the gasoline tax cut has dissipated, and coming to the rescue are the Obama administration's tax cuts. These real tax cuts. In fact, the cuts began to be felt in the first quarter. Personal income declined modestly in the first quarter by 60 billion, or a 2% annual rate. But personal taxes were down by 193 billion, some part of which was the result of the tax cuts, so that disposable income rose at a 5% annual rate. Putting taxes and lower gasoline prices together gave consumers 143 billion more to spend or save than they would otherwise have had, which accounted for the rather amazing performance of consumption in the face of immense job losses. And going further into the GDP numbers, there is an interesting statistic. Imports fell more than exports, mainly due to oil. The net trade deficit was only about 26 billion last month. Falling prices in imports, and especially oil, actually added about 3% annualized to the GDP number. Without that boost, the number would have been far more ugly. That being said, we are very likely to see better numbers in the future, and maybe even a positive one in the fourth quarter. But a large part of that will be statistical. For instance, housing construction is now down to 2.5% of GDP. Drops in housing construction have contributed almost a negative 1% a quarter for the last year. Even if housing construction goes down another 10 to 20%, it is becoming a very small piece of the puzzle and is not likely to be a big drag on future GDP. Inventories, though, have been a large drag on the economy for the last 2 quarters. While we could see inventories drop somewhat this quarter, as the ISM manufacturing number is still significantly negative, they will probably not drop a lot more in the third and fourth quarters. There are more stimuli and tax cuts on the way, and they will start to have an effect as individuals will have more disposable income, whether to pay down debt, save, or spend. But that positive will be balanced by rising unemployment, likely to hit 10% or more by the end of the year, in official numbers, of course. If you count those who are part-time workers wanting full-time work, or who are discouraged workers, unemployment is over 15% today. A dangerous endgame. The Fed and the Obama administration are playing a dangerous game. The Fed is going to print trillions of dollars to forestall deflation and try to reignite the economy. But for a variety of reasons we'll go into some other time, a real sustainable recovery may be a few years away. What happens when the markets start bulking at high and unsustainable national deficits? What happens when inflation finally does return? Can the Fed remain independent and take back the money it is printing in the face of what will likely be a tepid recovery? And if they don't, what happens to the dollar? Next year, we will be entering what will certainly be the most dangerous era in my lifetime for the US economy. It is not clear what will happen. There are a lot of paths that can be taken, though some are more likely than others. For those who are convinced that high inflation and a falling dollar are absolutely unequivocally in the future, I have just one word: Japan. Yes, there are differences, but there are lots of similarities too. While I think the most likely outcome is a long muddle-through recovery, the likelihood of a lost decade of deflation a la Japan is a very real potential outcome. And the possibility of stagflation and a seriously impaired dollar is also quite real. Investors, businessmen, and entrepreneurs need to be as nimble as possible. A free market will figure out what paths to take, and I am still optimistic about the very long term. But we have some very dangerous times in front of us, and we need to be realistic. And before I close, let me make a few comments about the Chrysler and GM issues. If I hold senior secured debt of a company and the government tells me I have to take less than unsecured junior debtors, I am not going to be happy. I may have been dumb to make the loans in the first place, but I did it under a very specific contract and the rule of law. If the Obama administration arbitrarily changes those rules to favor political class unions, then that is going to have a chilling effect on future lending to all corporations. As an aside, they are spending $12 billion to save 54,000 Chrysler jobs. That's 22,000 per job. With 600,000 jobs a month being lost, why are those 54,000 jobs more special than those of the rest of the unemployed, who gets a fraction of that amount in unemployment benefits? Actions have consequences. The lenders who are forcing the Chrysler deal into bankruptcy court are not all predatory hedge funds. They are mutual funds, pension funds, and other financial firms with small stakeholders as their investors. Cerberus, the hedge fund that originally brought Chrysler, deserves to lose their money. They made a bad investment. But those who lent money deserve to be treated in accordance with the contracts they signed. Demonizing investors and businessmen is hardly helpful. They are precisely the people we need to help get this economy moving. Governments don't create true job growth. Business people do, and mostly small businesses. I am not certain why small business owners, the job creation engine of the country, should see their taxes raised in order to protect bondholders of automobile companies or banks, or for union jobs to be preserved in companies that are clearly not competitive. But that is just my final thought late at night before I hit the send button. And so, finalizing. Today, there are those who say the stock market will start rising 6 months before the economy does. And maybe it will, I don't know. The predisposition of this market is down. Valuations are not at a level that has spawned major bull markets in the past. At the beginning of real bull markets, volume is strong and rising. Now it is weak, modest at best, and shows no real sign of becoming strong, especially going into summer. You all know the expression that says, sell in May and go away, right? Further, this rally has all the earmarks of a major short squeeze. Regulators have recently, and correctly, by the current standard, been enforcing short selling rules that require stock to be delivered and settled on short trades. This may be a one-time event. When the short squeeze is over, the buying will stop and the market will drop. Remember, it takes buying, and a lot of it, to move a market up, but only a lack of buying to create a bear market. Corporate earnings are likely to go even lower, as consumer spending is likely to get weaker in the coming months. Capacity utilization is at its lowest point since they began tracking it. The National Federation of Business says a recent survey shows none of the responders plans to raise prices, which is not a sign of business strength. Banks are not yet lending, and the past quarter's positive performance was mostly accounting gimmicks. Citigroup, for instance, said they made $1.6 billion. Paw! They did this by booking a one-time gain of $2.7 billion because the value of Citigroup bonds have fallen, giving them the theoretical possibility of buying back their debt at a discount. And with consumer and credit card loans showing more weakness, Citi decided to reduce its loan loss reserves, allowing it to show another $1.3 billion in profit. And then there was the profit of $400 million from the new mark-to-market rules, which allowed them to produce a profit on impaired assets. Without all these gains, there would have been a loss of $2.8 billion. Maybe this time is different. But when I survey the economic landscape, I see lots of opportunity for disappointments and missed targets. And bear market rallies are killed by disappointment and missed expectations. To belong this market going into summer, you need to be brave or have very serious stops on your portfolio. I think the possibility of mixed expectations at the end of the second quarter is high. It could get ugly. Okay, so I hope you enjoyed it. As always, if you did, you know what to do to receive more hot news in the future. Be cool. I'll see you all in the next clip.